Hey love, I'm Lianne. I'm a CPA, and this channel is where I talk about the emotions and the math behind your money. If you hold a Nasdaq ETF, for example, QQQ, or really any broad market index fund, you may be about to become a SpaceX shareholder, whether you want to be or not. And the reason why comes down to a rule change that happened very quietly in May that almost nobody in your feed is talking about. If you haven't watched part one on the SpaceX IPO itself, the link is in the description, but you don't need necessarily to see that first to follow along here. A quick note before we start, this is financial education, not financial advice for your specific situation. Always work with a qualified professional for decisions that are specific to you. So let me give you a brief recap. SpaceX went public on Friday at $135 a share under the ticker symbol SPCX. It did this on the Nasdaq exchange. It's the largest IPO in history, raising $75 billion at a $1.77 trillion with a T valuation, closing the day just above $2 trillion, or $161 per share. The company is basically losing money outside of one of its businesses, the Starlink satellite business. It's built significantly on government funding, and one person, Elon Musk, controls 85% of the voting power, even though he'll only own about 42% of the shares. That's to give you a little bit of a recap and context. And now, here's why it really matters, even if you never plan to touch the stock. The Nasdaq is essentially a marketplace, like a shopping mall for stocks. Companies can apply to list their shares there, and once approved by the exchange, their stock can be bought and sold on that exchange. SpaceX chose to list on the Nasdaq rather than, say, with a competing exchange, the New York Stock Exchange or NYSE. An exchange is basically a product, and they derive money from listing fees as well as trading activity. So attracting big companies is always good for business. In addition to the exchange, Nasdaq has the Nasdaq 100 index. This is a separate product. This is actually a list of all the 100 largest non-financial companies that are on the Nasdaq exchange, and they are ranked essentially by market cap. It's basically used as a benchmark to measure how that group of companies, non-financial 100 largest companies listed on the Nasdaq, is performing. A lot of ETFs are built to track the Nasdaq 100 index. The most well-known of this type of ETF is traded under the symbol QQQ. And when you buy QQQ, you are automatically owning a small piece of every company in the Nasdaq 100 weighted by size. The exchange is where stocks are bought and sold. The index is a scoreboard. And the ETF is a product that lets you invest in that scoreboard automatically. Now, the exchange and the index, both NASDAQ products, when a company goes public, there's a waiting period before it can be added to a major index. That waiting period is called the seasoning period, and it exists for a reason. It gives the stock time to stabilize, for the price to settle, and for the market to form a real view of what the company is worth. For the NASDAQ 100, the seasoning period was previously 3 months. For the S&P 500, it's 12 months. Plus, the company has to show 4 consecutive quarters of profit. Those rules protect index investors, the everyday people who are not doing stock picking, but instead holding ETFs like QQQ from being automatically exposed to a brand new, volatile, proven company. The seasoning period is investor protection, and it was quietly removed. Effective earlier this year, May 1, 2026, Nasdaq changed its rules. Any newly listed company that ranks in the top 40 of the Nasdaq 100 by market capitalization can now be added to the index after just 15 trading days. Reuters reported that SpaceX signaled early that rapid index inclusion was a central condition for its choice of stock exchange. Nasdaq and the NYSE both competed for the listing. Nasdaq changed its rules, and so SpaceX chose them. Remember what I said earlier? The Nasdaq exchange profits from listing fees as well as trading volume. And the Nasdaq 100 is a separate product. But when the same company controls both, the incentive might be to lax the rules around index in order to attract big listings. But the Nasdaq wasn't alone. The FTSE Russell also added a fast entry rule, allowing large IPOs onto its indexes after just 5 days. Also, Morningstar, CRSP, also eased some requirements. So it's not just one company that changed the rules or one index that is being impacted. Now, S&P Dow Jones considered that similar change but rejected it on June 4th. The 12-month seasoning period still applies, plus there is a profitability requirement. These remain in place. So essentially, for the S&P 500, SpaceX cannot enter it until at least mid-2027. And of course, we'll have to have those 4 quarters of consecutive profit. That means if you hold a broad S&P 500 ETF, for example, VFV is one or XSP is another, you are not automatically getting SpaceX right now. And that's honestly a meaningful distinction for a lot of investors. Where this stops being an abstract discussion and starts being about actual money today is for the people who aren't paying attention. So for pension funds and index funds that are tied to the Nasdaq 100, they are actually contractually obligated to buy SpaceX once it enters the index. Fund managers simply can't choose not to track it. Excluding a single company would require creating an entirely new fund, a fund that wasn't based on the index. Analysts estimate 22 to 27 billion with a B of automatic buying will flow into SpaceX from funds tracking the Nasdaq 100 and the Russell indexes. Nearly half of all index fund assets come from retirement plans. As one finance professor put it, if you're invested in a broad-based index fund that holds the entire stock market, you're going to be buying SpaceX whether you like it or not. And if you think about the governance concerns that I raised in video 1, the 85% voting control, the unfireable CFO, some pension fund executives have already called SpaceX's governance reckless. But because the index exclusion rules are there, they have absolutely no choice. So this really applies to funds tracking the Nasdaq 100, again, like QQQ, and certain other broad-based market funds. So you could hold SpaceX in as little as 5 to 15 business days. But if you hold an S&P 500 ETF like VFV or XSP, SpaceX could not enter that index until at least mid-2027, as long as those S&P rules hold firm. So check what index your ETF or pension fund is currently tracking. That one piece of information tells you whether or not you will be a forced buyer of these shares. And if you haven't watched part 1 on whether you should buy SpaceX directly, that is linked in the description, or maybe it will come up here as a video to watch next. So if you like this, share, like, all that great stuff, and pass this on to someone who holds index funds and has no idea of what might be happening.